All right, welcome back to another episode of Asset Coach and Tax Strategist. If you're a subscriber, thanks so much for subscribing. If you're not, please feel free to hit that subscribe button. Add any comments or thumbs up as you watch this content. We love to receive comments. It helps us guide us on what we want to do next and topics and questions that pop up occasionally. So today's episode, what we want to talk about is the current SEC chairman, Securities Exchange chairman. He came in, and this article was written back in March when he was going through the process of Congress and getting appointed and affirmed and all that fun stuff. But there was an article that came out that I wanted to share. It was on fortune.com. Due to the website issues and the pop-ups and all this kind of stuff, I cut and paste the article onto a Word document just to make it easier for us to communicate through. So I'm going to go ahead and share my screen. I want to talk about this. I find this to be very intriguing because this is an area that, quite honestly, a lot of people are unfamiliar with. And there's a lot of noise in this area. And this is the area of using cash value life insurance as an asset. And a lot of people are going to use the term investment. And I think it's an appropriately used term. I don't think life insurance should be considered an investment, but an asset class. And is there a difference? Absolutely. Absolutely. Because really investments are there to yield a result for you. It's typically a short, long-term, meaning that it's a lot different than an asset. An asset is something that you're a little more committed to, in my opinion. There's going to be differencing opinions, but this is my YouTube channel, so I'm going to use my opinion. So investments, you're putting money into something to yield a different result, and you're doing the same thing with an asset, but there's more of a marriage to an asset. There's more of an understanding of an asset, how it relates to the rest of your portfolio. Now, can an investment be an asset? Yeah, all investments are assets. I think it's more about your mindset and how you want to utilize that investment as an asset in what you're trying to accomplish in your plan. Clear as mud? Good. All right. So the reason why I want to talk about this cash value life insurance, because we use it as an asset, and another couple episodes from now, I'm going to talk about how to utilize, or how the wealthy get wealthy utilizing debt. It's going to be a big topic, and I usually, when we talk about things like that with this type of noise, and same thing with this topic, you get a lot of negativity, and that's okay. That's perfectly fine. Like I said, there's a lot of noise in this environment. Also, a lot of noise within the insurance industry, whether you should be term, whole life, index universal life, blah, 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 VUL, all that kind of stuff. There's a lot of internal turmoil as well. That's okay. It's based on you and what you want to accomplish, what your goals are. It's just hard to find all the information, and really unbiased information, or if it is biased, is it aligned with educating you to help you make a decision? Big difference. So enough of that. Let me kind of dive in here and let's talk about what's the uniqueness about this particular article. So again, Fortune magazine or fortune.com, income SEC chair Paul Atkins and his wife have 54 life insurance policies. Why? Right? If you could emphasize a word, why, I think that would be probably so emphasized in this article. Ben Weiss wrote this March 27th of this year. So it talks about him as a nominee. Now he's been confirmed. He has, equity in tech giant Alibaba. He has some crypto holdings, venture capital firms. He has a big portfolio of life insurance policies, 54 to be in fact. And so according to his recent ethics disclosure, which is where all this came out, which must be completed by the agency heads, they're questioning, or not they are questioning. The question in this article is, why would you have 54 life insurance policies? And so to kind of give some context, in 2023, there were just under 260 million active policies, which actually, truthfully, I'm shocked by that number. I am shocked. There's 350 million Americans, maybe closer to 400 million Americans. This is saying over half of them have life insurance policies. Well, Paul Atkins having 54 skews that a little bit. But I don't have just one. I have multiple. All of my members, my clients that I work with have multiple policies. Like if you're using it, at least for us, when we're using it as an asset, it's not the only asset. It's part of an overall plan, and we use that asset to create control decisions, being able to have a control over decisions. But anyways, according to the U.S. American Council of Life Insurers, fewer than one on average for every American adult. Meanwhile, the 54 life insurance policies represents 10% of Atkins' net worth. Only 10%, but as an asset class, 10%. Now, his estate worth is different. Your net worth is your assets minus your liability equals your net worth. Okay. But your estate value takes all of that plus your life insurance death benefit and depending on how it's structured as part of your overall estate value. It's different. Okay. But again, it's based on you have the ability within a life insurance policy. There's three parties. The owner, so a life insurance policy can have an owner, could be separate from the insured, who is the person that the life insurance actually on. If they pass away, the life insurance death benefit goes to the beneficiaries. Okay, so there are three parties. The beneficiary could be the owner. The owner could be the insured, but nobody can be all three, right? So in some of the videos that we'll talk about up in episodes coming up, for example, we'll use banks as an example. And so if you have a trust, your trust can be an owner and the beneficiary, and the individual will be the insured. So this is really important. Now, Bloomberg estimates that his net worth is close to 327 million. Okay, so not slim picking. So he's done really well for himself in making decisions, right? The decision to amass dozens of life insurance policy flummoxes even some experts. Okay, now here's the situation. So it would make no sense for an individual to have 20, 30, 40, let alone 50 universal life policies on their own life. Okay, a professor at University of Georgia, that's the first problem, who researches the insurance market, told Fortune. Why does it make no sense? Why, James? This isn't your plan. So it's Paul's plan. Paul's plan, it makes sense. Paul's plan is paying for this. Why does it make no sense for you, a professor? Okay. Why then does Atkins own so many? Okay. Well, they tried to reach out to him, and of course, no comment. Why would he? I wouldn't tell you why. Get out of my business. It's bad enough now you know my business. I don't want you to give more information in my business. So let's talk about life insurance. Perhaps the incoming SEC chair's dozens of life insurance policies are vehicles to reduce the taxes he owes. Could be. Timothy Harris, an economic professor at Illinois State University. It could be. Right? There are some great tax benefits to life insurance policies, and how you use it. There's other tax benefits. There are two main types of policies: term and whole life. No, that's not correct. Term and permanent. Term is temporary, where you're renting, and that's essentially what this is talking about, for a fixed period of time. Doesn't necessarily have to be a fixed period of time. You could have renewable term, where every year the premium increases based on your age, getting older, or you can have level, which is what these 20, 10, 20, 15, 30-year fixed periods he's talking about. Okay. Now, with regards to whole life, also known as permanent, it goes to age 120 is how the expense and the policy design is to age 120. It used to be or before 2021 used to be 100. Well, more and more people were living to 100, so they extended it because of life expectancy has extended, and that was effective in 2001. Okay, so as we look at this, there's different types of permanent policies. There's whole life, and there's different types of whole life policies. There's universal life, and then there are different types of universal life. More commonly, universal based on the equity or the investment, to use the terminology in this article. The equity appreciates based on interest rates. Well, as you can imagine, with interest rates being so low, this is not necessarily a good asset class to have if your equity is growing based on interest. Okay. But there's also certain purposes and reasons why you would use this. So that's not for this article. There's variable universal life. Variable universal life is where you have what's called separate accounts. They are like mutual funds, and the equity in the policy grows based on those separate accounts or like mutual funds. Okay. And then the third option is index universal life, where it too is a fixed type of product. You're not invested in indexing. There's a certain structure of how they do this, but the equity in the policy earns crediting based on the structure of the policy. So very, very complicated in having different versions of these, and every carrier designs them differently for a different purpose. Okay, so this is an asset class, no different than real estate. What kind of real estate are you going to go into? Single family home, short-term rental? Are you going to do multifamily? Are you going to do small apartments? Are you going to do commercial, industrial? What kind are you going to do? So within cash value life insurance and permanent insurance, I call it cash value life insurance. There's different reasons why you get these different assets. Okay, so now whole life insurance combines savings with a death. All of it has death benefit. All of it's life insurance. And the life insurance under section code 7702 within the IRS tax code gives you guidelines of what that looks like based on the equity and the savings inside of the policy versus the death benefit and what that looks like. Okay, now some people will say, well, this makes more sense to have this if you've maxed out all your other investment strategies. So 401ks, Roth IRAs, traditional IRAs, blah, blah, blah. Well, what if you're not a big fan of the stock market? What if you're not a big fan of 401ks? What if you decide that that's not something you want to do? What asset class would you have available to you? Well, you could go get real estate. You can go get cash value life insurance. There's a lot of different other strategies, but a lot of people are very narrow-minded and think that you have to max these out first because you got to be in the stock market and the equities market. Okay. And that's not necessarily the case. Many people, specifically business people, specifically the wealthy, most of them don't have a lot of money sitting in the stock market or in these types of vehicles. These are for middle class, lower middle class individuals. Complex finance is a speculative wager. Okay. Well, hoarding. Okay. Your hoarding life insurance policy isn't a normal thing. I wouldn't say he's hoarding life insurance policy. I think he's increasing his asset base. So no different than somebody who's buying multiple real estate properties. You're not hoarding real estate, right? And again, all these terms are coming from professors, which is why I like this article, because what the heck do you know? Right? Great, you're a professor. That's awesome. But the reality is that this gentleman has a net worth of, what was it? 327 million. At least 327 million in multiple asset classes. So this is not a professor's type of structure. Okay, this is somebody who's very strategic in how he's wanting to do this. Okay. Now he has multiple trusts, which is really important. And trusts and other various entities or companies is a good way of creating control, structure, protection of assets, managing risk, segregating risk in overall assets and what that looks like. So he's doing a great job with that. Companies often grant employees, board members, life insurance policies. So because he's been on a handful of boards, he could have gotten some life insurance policies from that as compensation. Because a lot of times you don't need more income because if you're on a bunch of boards, you already have generated your wealth. So having other vehicles like this makes more sense. No different than in the tech bubble, in the tech industry, there was options, right? Ownership and options was a vehicle of compensation because it made more sense to take less income and have the option to grow based on the value of the company to grow, and that was your payday. So no different than this type of asset class and what he's trying to do. Carson, the University of Georgia professor, believes that dozens of policies reflect something else, a decision by Atkins to purchase the life insurance policies of others. So this could be a part of it. There is something called life settlement where people actually sell their life insurance. And actually, when you apply for life insurance, one of the questions on the application asks, is your plan to sell this life insurance? Well, the opposite is true. This is as I said, life insurance is an asset class. Why? It's not just because of the cash that it accumulates, but the death benefit has value. So what if I'm somebody who is got only so much time to live? I have no heirs. I can't afford the premiums anymore. And the only asset I have left is this life insurance policy that I have had cash. The cash is paying for the expense of the death benefit, but there's a period of time where I just honestly, I'm not going to need this anymore. I don't have any heirs. Okay. So as an asset class, there are groups of investors that will actually purchase that life insurance policy. They'll underwrite. So when you first get life insurance, they underwrite your health. The better your health, the cheaper the policy because you're paying for it. On the backside, when somebody's selling the life insurance policy, the death benefit as a asset, the opposite is true. They're underwriting the lack of health because they don't want this policy to last for another 20, 30 years because this is an asset. It's going to yield a return. What's the return? The death benefit. So they're going to assess the cash. They're going to assess the health or lack thereof of the individual selling this policy, and they're going to look at the longevity and the underwriting of that, of what their return is on that life insurance. And the death benefit of the life insurance is a income tax free transaction or event. Okay. So this creates an entirely separate industry, and life insurance companies aren't necessarily excited about this because that means they still have to pay out the life insurance death benefit, but they plan for that in the very beginning. But they also know the odds and the statistics that they'll gather lots of cash and premium over a period of time, and a lot of times don't pay out the death benefit because people just say, I'm not going to deal with this. I'm going to cancel it. I'm going to surrender whatever cash I have left and just call it a day. Okay. But smart investors looking to diversify their assets look at this as no different than flipping real estate. When somebody buys real estate, they rehab it and they can decide to keep it or sell it. And it's based on the ability to sell it or what makes the most sense for the return of that asset. Same thing here. Okay. The death benefit is like real estate. You're flipping it. But what the event is many times the individual who's selling the policy, their life expectancy is a lot shorter now. They're not healthy and they're going to pass away within a period of time, and the investors keep that in. Now, here's the thing. They don't just take that away. They buy it from the individual. So let's say there's $1 million of life insurance, death benefit, and let's say there's $100,000 of cash in the policy, and this person has basically 18 months to 2 years to live. So they can't afford the premiums anymore. They're struggling to they just need that extra payday ahead of time to be able to just live out the rest of their life, whatever that means. Okay. So an investor will come in, they'll underwrite that, and they'll say, okay, so based on the premiums, the cash, the 100,000 in cash and the $1 million and 18 months to live, and they'll calculate, okay, maybe it's 24. It'll be dependent on how they determine that. We'll buy it. And so that they'll buy the $1 million plus the cash value, cash in the policy, and let's say they negotiate and the person says, yes, I'll take 200,000. So they write a check to that individual for 200,000, and the person who bought the policy will keep the policy, will use the remaining cash to pay for the expenses and add any additional dollars to keep that policy until that individual passes away, when then there's the payout of the $1 million. Okay. And when that happens, they'll look at all the expenses, the costs, so the 200,000 plus all the money to keep the policy in force that came out of their pocket, minus the $1 million. That's their profit or rate of return. Okay. So maybe that's what he's doing. Who knows? Maybe he's building up enough equity in these multiple policies because he has some policies that have well over $1 million in cash, and then some that just barely have cash in there. Who knows? Who knows? Right? But either way, each single one of those 54 policies is a separate asset. So if he were to have 54 single family homes, nobody would make a big deal about this. Be like, whatever, who cares? Or 54 different stocks in his portfolio. Nobody would care. But oh my goodness, he has 54 life insurance policies. Why does he do this? Very similar, like when someone has a car collection and they have 200 cars. Like, wow, that's a lot. It seems excessive. Well, guess what? Those are each assets. There's a value to that. Same thing here. So hopefully this was helpful. Hope you enjoyed this conversation. A little more insight. We can dive, hopefully, I think in the future episodes, we'll dive a little more into this asset class of what this means to just us in generally. If we're looking to build a diversified asset class, if we're heavy in stocks or the market, if we're heavy in our business, if we're heavy in real estate, or heavy in all of those, is this a separate asset class that makes sense for me? Can we use this to hedge the risk we're taking in other areas? Okay, so that's very important to bring down the risk of your overall portfolio in something that's completely uncorrelated and has different risk structures to minimize the risk in your other assets. Could be. So thanks so much. If you haven't subscribed yet, hit that subscribe button. Would love to have you here. Give us a thumbs up on this content. And I appreciate your time and your energy of being here. And you go make it a great day. Bye-bye.